Welcome to the deep dive. Today we are strapping in for a discussion that really challenges, well, almost everything we were taught about careers, security, and how to get ahead financially.
It definitely does.
We're looking at a classic piece of financial writing that basically holds up a mirror to the path most people take, the specialized education, the hard work, and it calls it a trap, a lifelong trap.
That's absolutely right. Our source material gives us this really stark, almost radical contrast. It's personified by these two figures, the poor dad and the rich dad.
Right.
So the common wisdom says, study hard, nail those grades, get a good, stable job, high paying, if possible.
The safe route.
Exactly. But the mission today is to kind of unpack this central, counterintuitive lesson. Why do people who work incredibly hard, who are highly educated, often end up struggling with debt, while others, following very different rules, seem to find financial freedom, sometimes quite quickly?
Okay, let's jump right into that core conflict. The poor dad way of thinking, it mirrors most traditional schooling, right? It pushes professional achievement. Like, study something secure, accounting maybe, be top of your class, land a safe job at a big firm. The goal, security. Maybe retire earlier.
Yeah, the educated father,
Yeah.
he genuinely believed financial stability came from having a good job. His core belief deep down was the love of money is the root of all evil. But the other father, the rich dad, he pushed a completely different idea. His focus was all on financial education, like learn how money actually works.
Not just how to work for money.
Precisely.
Yeah.
Make money work for you.
Yeah.
And his guiding principle, it just flips the whole script. He believed the lack of money is the root of all evil.
Wow. That's a sharp difference right from the start. It really sets the stage. So if you follow that poor dad advice, you end up in what the book calls the rat race. Can you describe that cycle? Because honestly, on paper, it sounds pretty good. Secure job, rising income.
It does sound appealing, and that's the trap. It promises stability.
Yeah.
The cycle usually goes something like this. You graduate,
Yeah.
you get that secure specialized job, could be a doctor, engineer, lawyer, whatever.
Yeah.
Your income starts going up. But almost immediately, you take on more financial burdens, credit cards start getting used more, maybe a nicer car.
The lifestyle creep?
Exactly. Then the big house.
Yeah.
Then maybe kids come along, which raises the stakes even higher. You feel like you're moving forward because you're earning more.
Yeah.
But are you really? Often, no.
And that's where the squeeze really hits. That whole cash flow loop, it forces you to see who you're actually working for. The book argues that working harder just makes you a better servant to, like, three main masters.
That's the ruthless reality it paints. When you get that raise or you work those extra hours, you're immediately making other people richer. Instead of getting closer to freedom, you're just running faster to stay in the same place, financially speaking.
Okay, so when you look at where that extra money goes, who are these primary claimants? Who gets paid first?
Right, so there are these three powerful players who get their cut before you really see much of it. First, the owner or the shareholders of the company you work for. Your effort boosts their profits, their stock value.
Makes sense.
Second, and this one's huge, the government. They take their share before the money even lands in your account. We're talking income tax, property taxes on that house, and those big chunks for Social Security and Medicare.
That can be, what, like 15% or more combined?
Easily, yeah.
Yeah.
Between what you pay and what your employer pays on your behalf, it adds up fast.
Okay, owner, government. Who's number three?
Number three is the bank. Think mortgage payments on that house, car loans, credit card debt you racked up, trying to maintain that lifestyle that keeps expanding.
Got it.
So the cycle just forces you to spend your best, most productive years working primarily for these three entities, the owner, the government, the bank. It's a relentless loop, and getting a raise often just tightens the screws.
So if that conventional path is a trap, how do you actually break free? This brings us to the foundation of financial literacy, which apparently boils down to one really simple rule. Deceptively simple, maybe?
It really is the core idea. The book hammers this home. The single most important lesson is knowing the difference between an asset and a liability. And then, consistently buy assets.
Okay, but let's be super clear on these definitions, because this is where the thinking really diverges from, what most people assume. What's the acid test? Asset versus liability.
It all comes down to cash flow, pure and simple. An asset is something that puts money into your pocket, period. Doesn't matter if you work or not. Think rental properties bringing in cash, businesses you own but don't run day to day, royalties, maybe some stocks or bonds that pay dividends.
Yeah, it puts money in.
Right. And a liability. Anything that takes money out of your pocket.
Kicks money out. Simple enough. But this is where that huge middle-class misunderstanding comes in, especially about the family home. Most people see their house as their biggest asset, right?
Absolutely, it's the dream.
Yeah.
But the book argues pretty forcefully that it's often the opposite. It's a liability, a big one,
Right. How?
because it consistently takes money out of your pocket every single month. People focus on the potential appreciation, maybe, but they forget the ongoing costs. There's the mortgage interest, which is huge at the beginning.
Yeah.
There's maintenance, repairs,
Yeah, always something.
and the big one, property taxes. The book uses this anecdote, right, about a couple, highly educated, whose property taxes just kept creeping up year after year, eventually hit like $1,000 a month.
Wow. Just in taxes.
Just taxes. It totally wrecked their retirement budget, which was fixed. They actually had to sell the house. So that asset became this huge drain.
Okay, so the house often pulls money out. If we picture these cash flow patterns, what does that middle class one look like, according to this view?
It's like trying to fill a leaky bucket. For the middle class, income comes in, maybe even a good income, but it flows straight out again to buy liabilities, the house payments, the car payments, the credit cards used for, well, stuff.
Lifestyle.
Exactly. Liabilities generate expenses. So no matter how much income flows in, it flows right back out through the liability leaks. The bucket never really fills up. You're trapped, needing to constantly work just to keep the flow going.
Whereas the rich pattern, as described here, the income goes somewhere else first.
Exactly. Income comes in and is directed straight into the asset column first. They buy things that generate more income. Small businesses, maybe rental properties, stocks, things that put money back in the bucket.
Ah, okay.
Eventually, the goal is that the income from those assets grows large enough to cover all the lifestyle expenses. At that point, you don't need the job anymore. Your assets are working for you. That's financial independence.
And it's fascinating, this idea that just being able to read the numbers behind this, that's financial IQ, skill number one. It's not about complex math, but more like reading comprehension for money.
That's precisely it. Financial statements, your income statement, your balance sheet, they tell a story in numbers. If you can't read that story, you can't tell if something is truly building your wealth, putting money in your pocket, or if it just looks good but is actually draining you dry. It's as fundamental as being able to read words.
Realizing that cash flow trap forces us to look inside, too. At the emotional reasons people stay on that treadmill, let's shift to those emotional drivers. The book says 2 main feelings keep people in the rat race, like a donkey chasing a carrot it never catches. Fear and desire. Or maybe greed.
Yeah, the system plays on very basic human emotions. The fear of not having enough money, of being broke that drives people to cling to jobs, even ones they hate, just for that feeling of security.
The paycheck security.
Right. But then as soon as they start earning a bit more, desire kicks in. The wanting mind. You want a bigger house, a fancier car, nicer vacations, the latest gadgets. The rich dad character noted, as people get older, their toys just get more expensive.
Yeah, I can see that.
And that desire pulls them deeper into spending, deeper into debt, because it just expands to meet or exceed whatever income comes in.
It is kind of depressing when you frame it like that. The things we aim for, the house, the car might just be weights pulling us down. And this fear, it also spills over into how people approach investing, creating what you call the cynicism trap.
Oh, absolutely. People become paralyzed by the fear of losing money. They adopt this chicken little mindset. The sky is always about to fall. The market's going to crash. So they play not to lose instead of playing to win.
What does that look like in practice?
It means they might have, say, $50,000 sitting in a bank CD, earning maybe 1% interest. Super safe, right? But inflation's eating away at it.
Yeah.
They're actually losing purchasing power. They do that instead of making a more focused investment, maybe in real estate or a business they understand, that could potentially yield much higher returns. They choose minimal security over potential growth because the fear of loss is just too strong.
Okay, this is where things get really tactical. The power of legal structures. This is financial IQ skill number 4, apparently. How do people who understand this stuff use corporations and trusts? Especially for taxes. It seems like a huge advantage.
It's a massive difference, and it's mostly about the order of operations. For a typical employee, the process is earn money, government takes taxes, spend what's left. That earned income is the highest taxed category.
Right.
The rich, or the financially educated operating through a corporation, they flip that process completely.
How? Explain that flip. It sounds kind of like magic.
It's not magic, it's just understanding the rules. A corporation allows you to spend first, then pay taxes. Legitimate business expenses, maybe that business trip, new equipment for the office, even a portion of car expenses if it's used for business, These are deducted before taxes are calculated.
At the top.
Exactly. You
Yeah.
pay taxes on the remaining profit, if any. For an employee, almost all spending happens after taxes have been taken out. For the corporation owner, many expenses happen before tax. It fundamentally changes how much of your revenue you get to keep and use.
And it's not just taxes, right? There's a legal protection aspect too, which the book really emphasizes the middle class often lacks.
Huge difference. Corporations and trusts create a legal separation. They allow wealthy individuals to control assets like real estate portfolios or stock holdings without technically owning them in their personal name.
So if they get sued personally,
Those assets held by the corporation or trust are generally protected. They're shielded. The middle class typically trying to own everything directly, the house, the car, the savings account, all in their own name. They become easy targets in lawsuits because there's no legal wall between their personal life and their assets.
okay, so we've established that just being highly educated or talented in a specific field isn't enough. The book is pretty blunt about that. We see examples like talented artists who think sales is beneath them, or doctors struggling financially.
Yeah, talent alone just doesn't cut it in this philosophy. The crucial missing piece for many professionals is developing management skills. Specifically, managing cash flow, managing systems, like business processes, and managing people. The Rich Dad philosophy encourages learning how the whole machine works, not just being one very skilled, potentially replaceable cog inside it.
Which brings us nicely to the last part, actually breaking the cycle. Mindset shifts and taking action. Rich Dad talked about 3 kinds of income, and the goal being a quick conversion.
Right. There's earned income from your job, your direct labor. That's the highest taxed. Then there's passive income, often from things like real estate rentals or maybe silent partnerships in businesses. That tends to be taxed much more favorably.
Okay.
And finally, portfolio income, which is income from paper assets, stocks, bonds, mutual funds, that kind of thing. The big strategic goal is to take your earned income and convert it as quickly as possible into passive and portfolio income streams. Those are the streams that make money work for you, often with better tax treatment.
And a big part of starting that conversion is tackling mental laziness. Rich Dad apparently banned the phrase, I can't afford it. Why?
Because saying I can't afford it is like slamming a door shut in your brain. It stops you from thinking, from finding solutions. It's an easy out.
So what's the alternative?
The alternative question is always, how can I afford it? That question forces your brain to open up, to get creative, to look for possibilities, to figure out strategies. It sparks financial ingenuity. Just saying I can't is accepting defeat before you even try. Mental laziness is just as damaging as physical laziness when it comes to building wealth.
I love that. How can I afford it? It shifts everything.
Yeah.
Now, here's a really interesting, almost scary tactic. Paying bills. Most people pay themselves last, right? If there's anything left. Rich Dad flipped that too. Pay yourself first.
Yes. This is a really powerful and frankly nerve-wracking discipline he advocated. The idea is, when you get paid, the first bill you pay is yourself. You move money into your asset-building column before you pay your mortgage, your credit cards, anything else.
But wouldn't that mean you might not have enough for the actual bills? That sounds stressful.
It is stressful, that's the point. By paying yourself first, you intentionally create pressure. The book argues that external pressure, like creditors calling, demanding payment, is a much stronger motivator than your own internal desire to save or invest.
So the pressure forces you to.
What? It forces you to get creative and work smarter right now to generate more income to cover those bills. You're forced to find new ways to bring cash in, rather than just dipping into savings or tightening the belt. That pressure, that need to solve the immediate cash flow problem, is what builds financial muscle, financial genius, according to this philosophy.
Wow. Okay, that takes guts. And finally, this idea of finding the formula. Investing isn't just random, it's about finding and applying a proven strategy.
Exactly. That connects to financial IQ skills 2 and 3, investment strategy and market understanding. Getting rich quickly, the book argues, isn't about luck. It's about finding a formula that works and then replicating it. You need to train your mind, which is your greatest asset, your real capital, to spot opportunities others miss.
Like the condo example.
Right. One person pays $100,000 for a condo. The savvy investor next door gets an almost identical one for $50,000, maybe through foreclosure or finding a motivated seller. That second investor made their profit when they bought, not by waiting and hoping the market goes up. They had a formula for finding that deal.
And part of finding those formulas is actively seeking out people who already know them, mentors, experts.
Yeah.
even unlikely ones.
Absolutely. Knowledge is the real currency. You find these formula by talking to people, learning from them. Take experts out to lunch. It could be a successful real estate investor, a tax strategist, maybe even someone working deep inside the system, like at the county tax assessment office. Learn their formulas, understand their perspective. That specific insider knowledge is incredibly valuable.
So wrapping this deep dive up, it really feels like this philosophy presents a fundamental fork in the road. You either choose financial education, embrace the challenge, maybe the risk of making money work for you, or you choose the apparent security of the conventional path, which this book argues is really just lifelong service in the rat race.
Yeah, and what really stands out to me is how much value is placed on your mind, on your intelligence, over just having money to start with.
Yeah.
The author talks about turning, what, $5,000 into $1 million in assets, throwing off cash flow in just a few years.
Ah.
Because he started learning these systems as a kid. His point is, intelligence solves problems. If you have financial problems, you need more financial intelligence. Money just follows the good ideas and smart execution. So the choice is, are you going to invest in your most powerful asset, your brain, your financial creativity, or just keep following old formulas that might not be serving you anymore?
The book quotes the saying, "You are what you read," which leads to a final thought for you listening. If your current financial situation isn't what you want it to be, what different information, what new knowledge, maybe what different books or mentors will you seek out today to start changing the formula that's running in your mind? Something to think about.